Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
LME 3-month copper. Until recently, the market had, more or less, utilized the medium moving average, currently at 84.78, as a sort of a base to push and test higher. And at the same time, the top side had been capped, sort of, by 3 separate, though not necessarily unrelated, resistances. The first was the April 2012 high at 86.65. This had been previously breached, but repaired. The second resistance was the flattish extension to the upper trend line of the June to August 2023 ascending triangle, currently 87.56. This one was, for the most part, not tested that much, but it was still there, and it relates to the April 2012 high, as it was created by the overflow in June and July last year over the same April 2012 resistance. 2 weeks ago we had a test of this resistance, and to be frank, it was found grievously wanting. The third resistance is unrelated. It is the neckline of the February to April 2023 head and shoulders continuation pattern, currently at 85.42. This was likewise penetrated in late December, the same as the April 2012 high, but again only had the single close above it back then. More recently, due to its declining angle, it had helped cap the market in late January, with only one single close over it, and again 5 weeks ago, with once again only a single close over it. However, 3 weeks ago, this resistance was breached and broken. So where does this very recent move higher originate from? Well, it starts at the base of the congestion between 83.46 to 84.40, containing the September 2012 high at 84.24, the February 2013 high at 83.50, the long moving average, currently 83.93, as well as the medium moving average, currently 84.78. However, this journey higher had been a tortuous one, as rises had been limited for a while by the previously mentioned neckline. Yet, the market had in late February built on the congestion below 84.40 plus the short medium moving average, currently 85.41, and finally a golden cross of the medium moving average up over the long moving average just over 3 weeks ago, and staged the move up over the neckline. Now, in all this toing and froing, the market had turned the recent head and shoulders pattern into a continuation pattern, and as I said 2 weeks ago, and I quote, possibly created another reverse head and shoulders pattern over December 2023 to date. There's a bit of debate about where the first shoulder should be measured from, plus such a pattern is in the wrong place. But for now, just keep a continuing close eye on the April 2012 high and the extension overhead, as I suspect they may become key. End of quote. Well, they will key indeed, with the move up from the 86.50 zone up as far as 91.64 and driven right through all the potential topside targets for the previously highlighted reverse head and shoulders patterns. So what now? Well, I've drawn in bright red a new late October 2023 to early February 2024 bullish Andrews pitchfork to show the bullish angle of attack. The market is currently sitting on the middle time, currently at 88.68. This is interesting here. Well, what is interesting here is there is no fallback onto a bullish shift pitchfork here. What you see is it. Secondly, keep an eye topside on the 38.2% Fibonacci line of the October 2020 to March 2022 move at 90.97. This one has capped the market last week and it is worth watching, as is the 50% Fibonacci line of the 2022 move at 8900. And the extension, once again, the June to August 2023 ascending triangle, currently at 87.56. LME 3-month aluminium. I keep repeating myself here. There was and is a lot going on here, and I sometimes think my trying to explain it may even have made it more complicated. To start with, we have the gapping move higher in December last year that led to the monthly key reversal up for bullish halfway hesitation in the middle of the rise and horn top at the end of the rally. Then there was a subsequent drop which was halted at the October 2022 base support down at 21.56. This in turn led to a rise up through two necklines from a pair of reverse head and shoulders continuation patterns. One from the February to April 2023 move, currently at 21.89, highlighted in bright red on my daily chart, and a shallow one from the June to July 2023 move, currently at 22.50, highlighted in bright green on my daily chart. In late January, the rise topped out at a third neckline, coloured in dark green on my daily chart, of the October 2022 to May 2023 head and shoulders top pattern, currently at 23.06, and then judderingly started to move lower. This is how I clarified what I saw 6 weeks ago, and I quote, "Over this last week," so that is 7 weeks ago, "over this last week another pattern started to develop in my mind, and I've drawn it unhighlighted on my daily chart. It's a late October 2023 to date possible potential diamond pattern. It's not a pretty pattern, but I would pay close attention to the converging trend lines for this pattern. I am not in love with this pattern, and I will retire if it does not perform. But it does have merit, and it is one to watch." End of quote. Now, 4 weeks ago, I highlighted this pattern in dark blue on my daily chart. It's still not the best such looking pattern, but as I said earlier, it does have merit, especially as we are now breaking higher. Hence, we would have a primary target X in the 24.12 area and a secondary, harder to reach target X1 in the 24.91 area, which is up off the top of my daily chart. A key factor in prompting me even to lay out these potentials has been the break higher late 3 weeks ago and early 2 weeks ago out of the small purple highlighted February to early March bear channel, a bear channel that I pointed out 4 weeks ago. This bear channel also has its own potentials topside of a primary target X2 up in the 23.36 area. So what's stopping the market getting to those targets? Well, the immediate resistance has slowly been overcome, and we are close to target X2. The resistance is at the previously mentioned dark green neckline, and then the unhighlighted March to May 2023 head and shoulders top neckline, currently at 23.23, are slowly moving from resistances into supports. As I said last week, and I quote, "Should we reach that high, then the target X2 would be liable to be reached, and the reassessment would be in order." End of quote. Now, two final things. The first may end up becoming a big thing in the future. We had a bow tie formation late last week of the rising short moving average, currently at 22.68, the slowly rising short medium moving average, currently 22.34, and the barely rising medium moving average, currently 22.35. For any who follow bow tie formations, you can easily see that these moving averages are in the wrong order. However, that being said, the theory indicates that the market will move in the general direction of the outgoing moving averages from the bow tie, which to be honest originally looked sideways, but now is becoming clearer as a move higher. Additionally, between 15 to 20 sessions after the crossover, we may see a significant move from this bow tie. In this case, and allowing for some holidays in between, the market may make a move between the 9th and the 16th of April. Now, I will not await with bated breath, as I'm not happy about this bow tie formation at all. Now, the final item is much more recent, and is the prospective golden cross we may have of the short medium moving average up over the medium moving average. Now, golden crosses are lagging indicators, but it is nice to have one just after a bow tie formation. It adds some comfort to the overall idea. LME 3-month lead. In mid-November 2023, the market reached its recent zenith at the same high we saw back in August last year, just over 2300, before turning around and leaving behind a V-top with a substantial extension from early December last year until late January this year. This extension ended up being a bull channel, which is still highlighted on my daily chart in dark blue. The market traveled along this bull channel, staging a false break higher in late January this year before dropping down all the way down to the congestion around 2000 in mid-February. This support was not spectacular congestion, but enough to hold prices in a pipe bottom 6 weeks ago. Since then, the market has risen into a very steep ascending wedge pattern, highlighted in bright red on my daily chart, before breaking lower, only to be held at the same support seen back at the start of this year, the January 2020 high at 2039, and leading to a fresh rally 4 weeks ago. This saw the market break higher over the 50% Fibonacci line of the March 2020 to March 22 move at 2135, and the 50% Fibonacci line of the May to November 2023 move at 2142, and even the November 23 to February 24 move at 2151. However, as I said 2 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189. End of quote. And so it proved to be, as we peaked 2 weeks ago in the middle of the week, with a high that was importantly lower than the one in late January. Prices have dropped down since, below all the moving averages, and most recently pushing down through the January 2020 high at 2039. The February 2020 low, down at 1994, is now under threat. All this action is making the big picture very clouded. All I have now is a consideration that perhaps, just perhaps, the action since November last year is a really big cat's ears pattern. It's too early to know just yet, but I would like to lodge that thought in your mind, just in case."
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.